Good morning and welcome to the Killik & Co market update. It has been a very volatile week for markets and we have seen some quite significant falls in markets across the world. If you have a look here at this chart for the FTSE 100 over the last year, you can see quite a notable fall over the last week. But as yet, the FTSE is not in what we would call correction territory. So we'd say the market was in a state of correction if it had fallen 10% or more. And as yet, the FTSE hasn't quite fallen that much. If we move over to the US, however, and look at the Dow Jones Industrial Average, that has had a 10% correction. So as you can see, it has been a very good year for the Dow. It has risen upwards quite consistently, but there is a very notable fall at the end, and that fall is just over the 10% level as of last night. So what's the reason for these market falls? Well, as usual, it's very difficult to pinpoint one particular reason, one particular cause of these falls. But I think over the last few months, the consensus has been that perhaps markets had got a bit ahead of themselves. They had been rising very consistently for a number of months, even a number of years. And I think some people thought that perhaps a correction was a bit overdue and that perhaps valuations needed to come down a bit just to more normal levels. So that's perhaps one of the reasons why we have had this fall. But the trigger, I think, was probably some very good wage data that came out of the US last Friday. So that showed that US wages were rising more quickly than expected, and that caused people to think that perhaps those wages would rise and cause a rise in inflation. That would perhaps encourage the Federal Reserve to raise interest rates more quickly than they had previously been planning to, and that would make it more expensive for companies to issue new debt and to service existing debt, and that's why the market came down. And I think it's important to remember that the Federal Reserve has committed to raising interest rates very gradually. And also, the only reason they're having to raise rates at all is that the economy is doing well. So at the moment, we're not really panicking. I think it's quite interesting to note that there has been quite a lack of volatility in the market over the last few years. So if you have a look here at this chart showing the VIX over the last 10 years, you can see that we did have particularly high volatility in the market in 2008, around the time of the financial crisis. We then had a bit of a spike in 2011. That was when people were quite concerned about Europe and Greece. But since then, volatility has been fairly low. But that said, we have actually had 4 other 10% falls in the market during this time period. We had one in 2010, one in 2011, one in 2015 and one in 2016. So having a 10% fall in the market is not particularly unusual, and at the moment we are not hugely concerned. However, it's definitely something to keep an eye on. And for the time being, we would be looking at portfolios and considering whether you have any stocks that would stand to benefit from a potential rise in interest rates. And over in the US, there have been another couple of events this week that have hinted towards higher bond yields and higher interest rates in the future. The first of these was a Treasury auction that did show slightly weaker demand than expected. So the US government does periodically issue new bonds via Treasury auctions. And in the one that took place this week, the demand was a little bit weaker than expected. So that just showed that perhaps investors are expecting higher yields, and perhaps the government will have to offer higher yields in future in order to entice investors to buy these bonds. The second event was a vote that went through the Senate earlier in the week. So they're looking to sign a deal for a new 2-year budget deal, and that will pave the way for higher defense spending and more debt for the US government. So at the moment, the US national debt is nearly $20 trillion, so that's incredibly high indeed. And if they are looking to borrow even more money, I think they will have to offer higher rates and higher bond yields on that money. So also that does point to higher bond yields in the US. And moving back over here to the UK, we have also had hints of higher interest rates here as well. There was a Bank of England meeting this week, and although they opted not to raise interest rates at the current time, in his speech, Mark Carney did say this. He said that monetary policy would need to be tightened somewhat earlier and by a somewhat greater extent over the forecast period than anticipated at the time of the November report. So that's really him warning the market that perhaps interest rates will rise more quickly than they're currently expecting. So definitely something to keep an eye on there. And that's perhaps a reason why we have seen some weakness in the UK market this week. Moving on to the week ahead, we are coming to the very end of the fourth quarter reporting season, so we do have much less companies reporting this week, but looking at the Killik list, we are looking at TripAdvisor and Airbus. That's it from us. Have a great weekend, and we'll see you next Friday.